What if two families had the exact same investments, earned the exact same average return, and one of them runs out of money in retirement while the other builds wealth? You'd probably say that's impossible, but it's not. It happens all the time. And the reason it happens is something most people have never even heard of.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions. So if you're within 10 years of retirement, what we're about to walk you through could be the most important concept you've never been told about. It's called sequence of return risk, and it's one of the most overlooked and dangerous risks in retirement planning. Here's the simplest way to think about it. When you're growing your money, let's say your 401k over 25 years, it doesn't matter how you got to an average return of 7%, whether the big gains came early or late, you end up with the exact same number. But when you retire and start taking withdrawals, that changes everything. You can have the same average return and run out of money, while someone else with the same exact portfolio ends up with millions. It's incredibly counterintuitive, but the math doesn't lie.
So let's walk you through it. Two people retire, both starting with $1 million. Both withdraw $50,000 a year. And over time, they both average a 6% rate of return. The only difference, retiree A hits the market downturn in the first 3 years. Retiree B hits that same downturn, but in the last 3 years. Same investments, same average, but completely different outcomes.
And here's why. Retiree A is forced to sell investments when they're down. She's pulling $50,000 a year out of a shrinking portfolio. She's locking in losses, and she's reducing the amount of money that's left to recover when the market comes back. That's the danger. It's not that the strategy was bad. It's that the timing didn't cooperate early on.
And here's the uncomfortable truth. You can't control market returns, and you can't predict when the downturns are coming. What you can predict is how much risk you're exposed to when it matters the most. That's the defense, and most people don't have one. So let's talk about the 3 biggest mistakes that we see.
The first one is staying too aggressive right into retirement. You know you need your money to grow. You're worried about living a long time. So you keep taking big swings. But you're doing that at the expense of being able to survive a downturn.
The second mistake is having no withdrawal strategy. You just take the money out as you need it. And that's not a strategy at all. We call that improvising. And we see it all the time. A newsletter shows up about a cruise deal and you can't pass up, or the markets are up, the accounts look great, so you feel like you can spend more. Instead of setting some of that aside for a rainy day, it ends up going out the door.
And the third is having no buffered assets. Everything is invested the same way, all in the markets. Which means when the market drops, every dollar you withdraw is coming from a declining asset. And if that persists, and downturns like 2008 and 2009 persisted, the damage can be permanent.
If this is the kind of risk nobody's ever walked you through before and you'd like to keep learning about what prepared families do differently, hit subscribe. There's a lot more coming. Now here's the good news. These risks can actually be managed, and here's the strategy we use. We call it a bucketed approach. Think of it as a retirement income buffer. We set aside cash, short-term bonds, and stable assets for the first several years of retirement, at least the first 5 and sometimes 10. That money isn't going to give you growth, and yes, there will be some seller's remorse when the markets are up. Why did I move that money? I could have earned more. But if that buffer allows you to avoid selling stocks when they're down, you've just protected the foundation of your entire retirement.
And my argument is this. The more financial strength you have going into retirement, the more money you should lean on 10 years of buffering instead of just 5. It gives you more confidence that your plan is going to work. Here's how the buckets work. We block money into 5-year segments. Years 1 through 5 might be in treasuries, CDs, money markets, assets where you know exactly what the money's going to be. Then you plan for years 6 through 10, subsequently then 11 through 15. It's an ongoing strategy, not something you set up day one. when you get the golden handshake, never to be touched again.
And here's something I think people underestimate. The bucketing strategy doesn't just protect your assets, it protects something even more important, your emotions.
Think about this. When you retire, you're basically saying that you don't want to work anymore. You want every day to be a Saturday, and you're going to live off your portfolio. These are people who may have gotten 2,000 straight paychecks, and now the paychecks stop. Innately, that's unnerving. That's different. Now, if that coincides with economic disruption, downturns in the market, a shrinking portfolio, you're living off money that's getting smaller, and that heightens your emotions. And heightened emotions lead to bad behavior, which leads to bad outcomes. If you don't have a plan going into retirement, it's going to be very difficult to build one in the middle of a crisis when you can't sleep at night.
I remember in '08 and '09 talking to clients who wanted to pull out money for trips, and we had to say, you probably can't afford this right now.
That $10,000 trip essentially costs you $20,000.
Because you're selling stocks that are down 30 and 40%. And to their credit, a lot of clients said, you know what, I think you're right. And when markets recovered over the next few years, they did those things. But that conversation only works if you have a plan, if you have a buffer, if there's a structure in place that lets you be flexible. In this case, reduce spending in bad years and increase it back when things are strong again.
So we harvest the profits in strong years, put them in safe places, and that gives you the confidence and the income to weather the storms. And if you're retired for 30 years, you're going to run into bad economies. It's inevitable.
Probably several. There's an old guy, there's a story about an older guy in our business who was talking to a kid just entering in the business. He said, son, in your career, you will see 4 bear markets. So what's a career? Maybe 40 years? That's one every 10 years. Does it make sense to go into retirement planning for bad markets and expecting them? Or would you rather be surprised when they happen and try to adjust on the fly?
And don't overlook the tax side of this. If you have diversified tax buckets, meaning taxable accounts, IRAs, and Roth IRAs, you have flexibility in how you distribute money. You can pull from different sources depending on what the market and the tax code are doing in a given year. If you don't have that diversification, you lose that flexibility when you need it the most.
Here's the bottom line. Sequence of return risk isn't about how much you earn. It's really about when you earn it. And if you ignore it, it can quietly undo decades of disciplined saving. People in our business often say there are a lot more people who die coming down Mount Everest than going up. It's the same in retirement. There are more people who run out of money after they stop working than while they were building it. So if you're within 10 years of retirement or you're already there, the question isn't whether a downturn is coming, it's whether you're ready for it or not. And the families who are ready, they planned for it, they buffered for it, and gave themselves something incredibly valuable. Stability, confidence, and the ability to stay invested when it matters most.
I think the biggest takeaway is to be aware that this risk even exists. Most people have never heard of sequence of return risk. They just fall back on average rates of return. The average has always worked out, I'll be fine. But averages don't pay your bills. And the consistency of your returns matters a lot more than the magnitude. If you're approaching retirement and you're not sure whether your plan accounts for this, or you don't have a plan as of yet, we'd be happy to walk through it with you. There's a link below to schedule a conversation.
Now, sequence of return risk is one piece of the puzzle. But here's what really keeps us up at night. Most families think retirement planning is about saving enough. It's not. The 5 years before you retire are often more important than the 30 years after. And the mistakes families make in that window, they can't be fixed. Because at that point, going back to work isn't an option. If you make a bad decision at 50, you recover. If you make the same decision at 65, that mistake follows you the rest of your life. If you never stress tested your portfolio for what happens when the market drops right before you walk out the door, and you don't know what the retirement red zone is, you need to watch this right now. Because investing is the easy part. It's the 5 years before you stop that determine whether your retirement actually works.